Hey everyone, welcome to another video by Stock Trades. My name is Matt and today we are going to take a look at a couple of value stocks that might be of interest to investors. But before we get into that, I did want to spend a little bit of time talking about some of the big news that have come out of the OSFI, and we'll do that right after this. So we talked about the OSFI a few times on our channel. The Office of the Superintendent of Financial Institutions essentially provides oversight to Canada's financial institutions, including Canada's banks. Well, this past week, there was a notable announcement made. On Thursday, the OSFI announced that the Domestic Stability Buffer, so DSB, would rise to 2.5% from 1% currently. So you might be asking yourself, why is this important? Well, the DSB forms part of the CET1 ratio, a core bank capital measure. In essence, banks are required to hold a certain percentage of capital against risk-weighted assets to ensure that we don't suffer another financial crisis. You can correct me if I'm wrong, but if I'm not mistaken, the CET1 ratio was introduced in the mid-2010s, and all banks were required to hold a certain amount of capital against their risk-weighted assets. Higher capital buffer means less cash to distribute to shareholders via dividends or share buybacks, for example. But it has proven to be an effective measure to keep our banks well funded. The move is also not all that surprising. In fact, it was expected. The DSB was lowered to 1% from 2.25% at the height of the pandemic, given the uncertainty faced by financial institutions. So the increase announced this past week, which is expected to take effect in October, is effectively only 25 basis points higher than pre-pandemic levels. This is by no means a deal breaker, especially since all of Canada's banks currently have CET1 ratios well above 10.5%. More importantly, to me, it signals that the OSFI recognizes that there is going to be a return to normal. The economy is starting to rebound, and the OSFI recognizes this. And this is very important because, in my opinion, it is a key step in allowing banks to once again raise dividends. And that is what investors really care about at this point, is when can banks start raising dividends again? Well, this is step one. Whether it be next quarter or after October 31st, now we have somewhat of a better idea of when the OSFI is going to lift that cap. Speaking of banks, the first stock I want to talk to you about today was TD Bank. Canada's banks have had an incredible run this year, with every single one of Canada's big banks sitting on double-digit gains. In fact, even the smaller banks are all sitting on double-digit gains. It's been a very good time to hold Canada's banks. So, now that they've run their course, is there still upside left? I would say yes. As a whole, Canada's banks still provide decent value. There is, however, one that stands out in terms of valuation, and that is Toronto Dominion, so TD Bank. It is one of only two of Canada's big six banks that is currently trading at a discount to its historical averages. While the Royal Bank of Canada is currently trading at a modest 5% discount, TD Bank is actually trading at an 11% discount to its historical multiples. Keep in mind that while TD Bank is undervalued compared to its peers, this doesn't mean it has underperformed. In fact, the company's gains in 2021, which are north of 20%, are right in line with the average. That means that something is likely holding it back. And that something is twofold. The first is provision for credit losses, and the second is bank overdraft fees. In the second quarter, TD Bank saw the biggest swing in PCLs, so provision for credit losses, going from $3.2 billion charged last year to a $377 million recovery in the second quarter of 2021. It was one of only two banks to post a recovery, and it was the largest recovery by a long shot. Why is this a negative? In theory it isn't, but analysts jumped on the big discrepancy as compared to peers. It has also led to a big artificial beat on earnings. However, that is true of all Canada's banks. They all posted significant improvements in PCLs quarter over quarter. So in theory, all of their earnings have been artificially inflated. Bottom line, in my opinion, it's not a negative unless the company was overly bullish and ends up having to reset next quarter. And we'll see what happens here. But in my opinion, TD Bank has one of the best management teams, and there's no reason to doubt that the company's recovery is not well in line with what is going to happen moving forward. The second headwind is the threat of cancellation of bank overdraft fees in the US. In recent news, Ally Bank in the US eliminated overdraft fees, and it's been a hot topic of conversation among lawmakers. And should all of the banks follow suit, TD Bank is expected to be most impacted. Why? Well, quite simply because it has the highest exposure to the US retail market. In the last 12 months, TD Bank earned $400 million from overdraft fees in the US, and that would reduce TD's forward earnings per share estimate by approximately 3% if they were to be eliminated completely. While this would have a short-term impact on the company, long-term, TD Bank is still well positioned for exceptional growth. It still has one of the highest expected growth rates in the country. And circling back to the recent announcement from the OSFI, TD Bank has the best CET1 ratio in the country. What does that mean? It means that it will be best positioned to raise dividends or buy back shares as compared to its peers. So the company is well capitalized, has one of the highest growth rates in the sector, and in my opinion is going to continue raising the dividend at a higher clip than its peers. To me, TD Bank provides excellent value here, despite the fact that the banks have run up in value. The next company that we're going to be talking about today is Enbridge. Much like banks have seen an impressive run in 2021, Canada's energy sector has also performed quite well. The best part about the energy sector is that there are still many stocks that are trading at pretty cheap valuations, and that includes Enbridge. Enbridge, even though it is up by approximately 22% this year, it is also trading at a 22% discount to historical valuations. One of the main reasons for Enbridge's recent struggles is the unfavorable US political environment. Pipelines are being targeted by the Biden administration, and the Line Replacement 3 project is caught up in the crossfire. There are numerous legal proceedings surrounding the flagship pipeline. Last week, Enbridge did receive a little bit of good news. It was awaiting a decision from the Minnesota Court of Appeals on whether or not Enbridge had completed proper analysis on the potential impacts to the Lake Superior watershed in the event of an oil spill. So that decision was expected last week, and the ruling came in favor of Enbridge. That means that they were able to restart construction. The risk was significant in that had the ruling went against Enbridge, their permit would have been revoked and the project would have been delayed by another 6 to 12 months, which would have left more opportunity for opposition to build their case against the line completely. So the good news is that the company can proceed. It's certainly not out of the woods yet. There are many legal challenges mounting. The Biden administration is being pressured to act against Line 3, so we'll see what happens. But it's important to remember that like TC Energy and the Keystone XL pipeline, Enbridge is not a one-trick pony. While Line 3 is an important project, it's not the be-all and end-all for Enbridge. The company has a slew of other projects in the pipeline, and we think that Enbridge is well positioned to continue rewarding investors. Remember, this is a company that's generating consistent cash flows. The prices of oil are going up. The company is seeing big improvements on flow-throughs on their pipes. So bottom line, Enbridge is well positioned. The other thing that's important to note about Enbridge is that unlike some of its other pipeline peers, it's been a few years now that Enbridge has been pushing their environmental strategy forward. So the company is actually making some investments in the ESG side of things. And it has been doing so for a few years now. In a way, it's got a leg up on its competition. So the company is shifting towards renewables and it's putting money into renewables. So Enbridge is no longer just a pure play on fossil fuels. It has recognized that a shift is coming and is positioning itself to be a leader in that area. Enbridge has the cash, has the size to make the transition, and we think that it's going to be a successful transition. So worth noting here that Enbridge, in my opinion, it still provides excellent value to investors. With that, we're at the end of our video. I want to bring to investors' attention a couple of blue chip stocks that, in my opinion, were trading at a discount. We have TD Bank, which is well positioned to reward investors, and it's actually one of the best positioned to raise dividends once the OSFI lifts that cap, which, as we talked about, we expect to come very shortly. Enbridge, while it's doing quite well, up 22% this year, it still has plenty of room to run. It's trading well below historical valuations, and it hasn't performed as well as some of its peers. So we think that there is more upside to Enbridge than some of the other pipelines in the country. Please let us know in the comments below. Do you like TD Bank? Do you like Enbridge? And what do you think about the news of the OSFI? Are banks going to be able to raise dividends by the end of 2021? I think it's all about a guarantee, but be interested in hearing your thoughts. And like always, please subscribe to our channel and like our video for more great Canadian content. Until next time.